Okay, good afternoon to members of our learning community and also friends. We're eager to welcome you to our 5th webinar that we're doing to help business owners navigate all of the prolonged uncertainties from the coronavirus. We're now about 5 years in, or 5 weeks, X that, 5 weeks in, and there's been a lot of uncertainty and we're continuing to get more clarity. And pleased that Mario is with us. But before I say more about Mario or the topic, I want to let you know that we are recording this, and so you can access both the audio and the visual and the video, as well as the slides later on. Also, we will be entertaining possibly some questions, but Mario said there's pretty much a full hour of input. So you're welcome to ask some questions, but you can which we might get to at the end, or you can also email Mario directly. Jared, can you give them a little heads up of how to do that?
Yeah, so just so you can have it right away, if you wanted to, here on this first screen, you'll see Mario's email there, so you might want to jot that down. But if you wanted to ask a question, again, if you haven't been on Zoom, if you're on a laptop or a desktop, at the bottom, there should be a little icon that has quote bubbles there. It says Q&A. You can click on that and then type in your question and just hit submit. And if you're on a mobile device like a phone or a tablet, it may be somewhere on the screen where the rest of your menu options are. You may need to touch either the top or bottom of your screen, and that same Q&A box will come up. So we'd appreciate if you use that rather than say the chat function. It helps us navigate that better. So.
And again, Mario will entertain questions. You can email him directly afterward. So for those of you who don't know Mario Vicari from Kreischer Miller, he is what I would call a first responder in all of this COVID stuff and understanding all the legislation. I think he's been about the first one out with the information, translating it over and over again. So I've worked with Mario for over 20 years. He's just a really excellent business advisor, strategic thinker, always thinking ahead. And so we're eager to have him present. And I think that's it. Mario, let's turn it over to you so you can enlighten us.
Thanks, Allie and Jared. Glad to be with everyone today. We're going to cover the forgiveness provisions of the Paycheck Protection Program. And as Jared said, my email's here on the front page of the slides if you do have any questions that we don't get to. To begin with, I want to make just a couple of points. The first is that the CARES Act became law on March 27th, and in there it refers to a 30-day window to issue regulations. The Department of Labor is the agency of the government who is implementing the Paycheck Protection Program, and as well as these forgiveness provisions. So as of today, we have not gotten regulations specific to the forgiveness rules. So what's going to follow is our read of the law. There's, as you'll note as we go through it, and I'll highlight things, you'll see that I have some things in red, some things bolded. There's a lot of ambiguity in some of the terms and what they really mean. So I'll give you my best interpretation of that as we go along, but I'll point out where we need clarity on the regulations from the SBA. The other thing that's very important to note is that you're going to need to make an application for forgiveness of your loan with your lender. And so your lender's going to be the party who's going to review that application, and then it gets sent to the SBA. So it's very important that as this progresses, that you're in touch with your lender regarding your forgiveness calculations, because that's the party that's going to be approving your application. So we're going to begin then. So what we're going to cover, excuse me, is an important timeline here as to how the forgiveness rules work. Excuse me. And we're going to talk about definitions and certain tests that you've got to follow for forgiveness. We have a few short case studies. We'll talk about the application process, how to integrate the forgiveness calculations into your business planning, which we're all doing these days. just trying to figure out what our year is going to look like and our cash flows. What happens if you don't qualify for loan forgiveness? And we're going to talk for just a few minutes on taxes. So the first thing we're going to talk about is the timeline, which is very important. The timeline here, start to finish, is a 6-month period, the way the law is written at this point. But importantly, there's a timeline that begins to start ticking on the day that the loan originates, which the way we view that is when you receive the proceeds of your loan. Many of you on the call probably have already received proceeds, or you're going to be getting them within the next week. Our first knowledge of anybody receiving a loan would have been last Monday among our clients, and we've had many receive loans during last week and into this week. So the important thing to note is once the loan originates and you receive the money, there's an 8-week period that's very, very important as to when these forgiveness calculations need to be tracked, and principally based on the usage of the funds and meeting certain employment tests. So those of you who have not received your money yet, you have a little bit of time to plan, but those of you who have, you are already going to be in this very critical 8-week period. So that's the first timeline that matters. June 30th is another very important date because that's the end of the date period that you can apply for this loan, which, by the way, to the extent that there's people on the webinar today who have not yet put an application in, we do not know whether there's going to be more funding, but my guess would be that there's likely to be more. As you may know, the SBA sent a note out last week that they had exhausted the funds, $349 billion, but there's currently a bill being negotiated in the Congress to put another $310 billion into the program. So I would still put your applications into your lender as soon as you can to get in the queue, so that when the SBA does start taking more applications once it's refunded, then your application can go in. So June 30th is an important date because it's the end of the application period, but also there are certain forgiveness tests and exemptions from those tests that you have until June 30th to meet. Once you go through this covered 8-week period, sometime after that, you actually have to make a loan forgiveness application with your lender. And it's whoever granted you the loan has to give you, or you have to make a forgiveness application. As far as I know, these applications are not yet available. I believe banks will likely have their own application, and/or the SBA will provide a standard application. So you want to keep your eyes open for that because we're certainly looking for it. After you receive that, or after you submit your loan application or your loan forgiveness application, then the lender has 60 days to respond to you. And so then the way that this program is designed to work is from origination, there's an 8-week period, so call that 2 months. You need a little time to get your math together to submit your application. Then you've got another 2 months until the lender responds. The idea is that if this all works well, that you will be able to do the math and get forgiven the loan before the loan becomes due. There's a 6-month deferral from origination of this loan. Interest still accrues, but no payments of principal and interest are due in the first 6 months. So this is the deferral period for the loan. If there is money due on the loan that isn't forgiven, then this loan starts to begin to amortize at the end of 6 months for up to the 2-year period. So we're going to go through some very important definitions. And again, I'm going to point out ambiguities and things along the way. Again, this covered period, you're going to hear that a lot in my comments. That's that 8-week period, and it's very critical that you're attentive to paying attention to how you're spending these funds. Covered rent obligation. Rent is one of the allowable uses of monies to qualify for forgiveness in the covered period. And the key definition here is it's rent obligated under a leasing agreement in force before February 15th. So I expect that when you have to present your forgiveness calculations, you're going to need to present a lease that's been executed prior to February 15th that explains the rent amounts. There's also, I have this in red also because we've gotten a lot of questions and I don't know the answer to it. But the questions that we've been asked are, well, what about rent on equipment leases or other kinds of rentals? do they count here as covered rent? Our understanding about the intent of the law was it was supposed to be rent on building facilities and things like that. So, but I don't know for sure. So that I have this in red because you want to make a note on your slides if you're making notes that you want to pay attention to the guidance to see whether they're also going to allow leases of equipment or copiers or vehicles or other things to qualify as rent. For now, my understanding of it is that it's facilities, but we're going to be looking closely at the guidance to see what they tell us if there's other things that can be included. Usually we view rent, the term rent being associated with a facility versus a lease payment being associated with a piece of equipment or another leasing arrangement. The other thing, another important definition is a covered utility payment. Utility payments are part of the allowable costs in the use of the funds. And they did give us some definitions, but one of them is pretty blurry. So payment for the services and distribution of electricity, gas, water, going to skip the next one, telephone, and internet access. So those expenses can be part of how you use this money in that covered period to qualify for forgiveness. But we do not know what transportation means. This is the only, there's been no definition of what that means in terms of a utility. So you want to pay attention for further guidance there. The best I can think of is it could be fuel, gasoline, diesel, things like that on any kind of transportation equipment that you might have. But we're not really sure at this point. So again, guidance is going to be very critical as we move this forward. And hopefully that guidance comes very soon. So payroll costs is a very important definition. And, I was on the webinar a few weeks back, I guess it may have been 3 weeks ago, with Sally and Jared to go over the application process. The important thing to note relating to payroll costs are that the same definition of payroll costs that you use to apply for your loan are the same definitions that apply when you calculate your loan forgiveness. So the spend of the money on the back end in the final 2 weeks is the same definition as how you should have applied, when you went for your loan. So we're going to go through this, and payroll costs is the predominant use of the money under the requirements of the law. 75% of the money that you spend should be, in these areas of cost. So we're going to go through them very quickly. The first 4 bullets here, salaries, wages, tips, vacation, sick leave, allowance for dismissal. These are things that typically would be in somebody's gross wages that would go into their W-2. These wouldn't be separate payments or anything like that. So you want to think about, these first 4 would be things that go into the person's W-2, and you should be recording them at gross. Whatever the person's gross pay includes with these things included in it. The other payroll cost that's important to note is that group healthcare benefits, including insurance premiums that you pay to provide group healthcare benefits to your employees. Now, these benefits only should be the employer's portion, not the employee's portion. So that's going to be a pretty large amount of money typically, because it's a significant benefit. Retirement benefits is also another cost that counts as payroll costs, and there you would be looking at any kind of profit sharing or 401k match. Again, just the employer's portion. If you're an ESOP company, it could be your contributions to your ESOP. If you're a union company with union labor, this would be your, the group healthcare would be your contributions to the health and welfare program, or in the retirement side, your retirement contributions to the union pension. And then lastly, an inclusion in payroll costs is state and local taxes assessed on the compensation, meaning the state and local taxes that the company would pay, not the withheld taxes of the employee, but the taxes that the company would pay. In Pennsylvania, one of those taxes is state unemployment tax, that there's a certain amount that everyone pays up to a limit. That would be allowed to be part of your forgiveness calculation. There are some excluded costs in payroll costs. The first and most important is that whenever you count somebody in your forgiveness calculations, you can only count their wages up to $100,000. So when you do the math on forgiveness, if somebody's at an annual rate that's greater than that, you can only include them in that period assuming that they're earning $100,000. This second one here has gotten a lot of attention. There's been a lot of misunderstanding about what it means. And that would be taxes imposed under chapters 21, 22, or 24. These are FICA, federal withholding, and railroad retirement benefits. That's what they are. And just to note here, these are things that are excluded, not deducted. A lot of people, when they made their application, they put the gross payroll on back here in this section. And then when they looked at this, they deducted all of these things from that. And that is not the way you're supposed to do it. Because what would happen if you did that is then you would be applying for a loan at the person's net pay when it's intended for you to pay them their gross pay after the fact. So the point here is that you just can't include these amounts, FICA, federal withholding, or any kind of railroad retirements on top of the amounts that you've already included, because they would be included in the gross wages. It's just that you're withholding them on behalf of the employee. So you don't add them twice. Your employees, if they have a residence outside of the US, they're excluded. And to the extent that you're paying wages to anybody for sick leave or family leave under the Families First Coronavirus Response Act, and you're getting tax credits under those programs, you cannot include them in allowable costs for forgiveness because you're already receiving a benefit from the tax credits for those payments. So payroll cost is an important definition because it's going to be most of what you're going to be spending the money on in that subsequent 8-week period. And again, if you did the application properly, you probably would be calculating these things the same way, you know, in the 8-week period as you did in the upfront application process. So when it comes to understanding the loan forgiveness provisions, there's 2 steps. And the first one is to determine the amount that's eligible for forgiveness. That doesn't mean that you get it automatically. It's just to determine what's eligible. So we're going to do that first. So I'm going to use a standing example here of $1 million loan as we go through this. So if you received $1 million loan, the first step in figuring out your forgiveness is to determine how much of the $1 million is eligible. There's other tests that come later to determine whether you get forgiven all of it. But the first step is just to determine how much of the $1 million is eligible. And that has to do with whether you spend the money properly during that subsequent 8-week period. That's why I said early on that covered period is a critical period of time, because the first step in forgiveness is that during that 8-week period, you have to be able to provide documentation that you spent the money in a certain way. And here are the ways that you have to spend the money. Before we get there, though, to make a note that both principal and accrued interest are all forgivable under this program if you meet the forgiveness guidelines. So it's not just the principal on the loan. So to be eligible, the law says that you have to be eligible for forgiveness of indebtedness on a covered loan in an amount equal to costs incurred and payments made during the covered period. We're going to talk about this later, but that's a very curious definition because it can be made to broad interpretation. And we are expecting to get a lot of specifics, guidance about what that means. Costs incurred and payments made, you could look at that as saying, okay, well, there's 2 categories. Is it costs incurred during the period and payments made during the period, or is it, oh no, the cost has to be incurred in April and also paid in April? So you imagine the confusion that would create if you, for instance, you had a payroll in March that was earned in March, but you paid it in April. So a lot of people are kind of up in arms about this. I think we're going to get better guidance on what this means. My interpretation of it, though, is that what I'm advising people, absent any guidance, is do it the same way that you did it when you made your application. They didn't ask you to worry about whether your payroll was earned in one period and paid in another. So for now, what I'm telling people is focus on when you're paying things and think about doing it the same way that it was done when you made your application. Again, we still got to get guidance on it, but that's my interpretation. I don't think they're trying to make it more complex than it already is. So there's, but this, I just want to point out, these words can be construed, very differently. So, but for now, I'm focusing on doing it the same way that they asked you to apply. So the way that you spend the money matters. And these are these definitions that I just went through in the first set of slides. So 75% of the money has to be used for those payroll costs, which include your gross wages, health insurance, retirement, and some of those state taxes the company pays. And then you can also include amounts eligible for that rent that we talked about, utility payments that I gave you the definition on, and then also something that you pay on interest on any mortgages. So if you have a mortgage payment, you're allowed to include the interest payments on the mortgages during that 8-week period as being a cost that's allowable for forgiveness. A note here that's important is that in the law, there's 2 sections related to the Paycheck Protection Program. 1102 is what describes the program, and it has a section in it that says allowable uses. The 1106 is the section of the law that deals with the forgiveness calculations. There's a difference in what's included in one versus the other, and it's interest payments on any other debt obligation incurred before February 15th. So we're not sure whether this counts as a forgivable amount or not, but just make note that that's something where we're going to get some guidance. So I have it highlighted here because we're not sure, but you want to make note of it because those of you that have interest on any other kind of debt obligations, you want to be tracking it just in case it ultimately does get included. The other thing I would point out here that we've gotten questions on is, what is a debt obligation? Does that include a lease, like a lease obligation, or is it just a loan? My interpretation today is that a debt means a debt, like a bank loan, whereas a lease is usually called a lease. But I expect that there'll be clarity given on the regulations. But for now, my observation is debt means a loan. Lastly, if you've received an emergency injury disaster loan, otherwise known as an EIDL loan, if you have received that, you can't have that and a PPP loan. So if you received an EIDL loan, you're going to be having to have that refinanced when you get your proceeds from your PPP loan. And as long as the EIDL loan was used for payroll costs, it counts in the 75% category. Also, those of you who may have applied for an EIDL loan know that you got a $10,000 grant at the time that you applied, which is a forgivable grant. That reduces your forgiveness if you go for the other loan because you've already been given a forgiveness on it. So stepping back for a minute, the way that this works is that you go through this 8-week period and you calculate all of these things. And then what you have to do is you add everything up. And if you had $1 million loan and you only spent $900,000 of it on these categories, at that point you would have a $100,000 loan that you have to pay back because the amount of the loan wasn't all used properly. So it's not all eligible for forgiveness. The only amount that's eligible is the amount that was properly spent in these proper categories during that 8-week period. Now, once you determine the amount that's eligible, you're not done with the math because you have to meet 2 other tests, which we're going to cover now, one of which is a test for retention of your employees and another test for the maintenance of wage levels. And so we're going to continue to talk about those. So once you determine the amount that's eligible, in my example, let's just say it's the $900,000. Remember, $1 million was the loan amount, but we only spent $900,000. So at that point, we owe back $900,000 is eligible for forgiveness. The first test then to make sure that you're eligible to be forgiven the whole $900 is based on the reduction. You can have that amount reduced based on a reduction in the number of employees. So what they're saying here is that we want to make sure that this whole program was predicated upon maintaining employees rather than laying them off. That's what the money's intended to be used for. So the first thing that's very important here is that they give us a definition of what an FTE is and how you calculate it. So this is very important to note. The average number of full-time equivalent employees for each pay period falling within a month. So anytime that they tell you to determine FTEs, you have to do it based on each pay within a month, and then you take an average. So it's very important. Now, it's in red because I believe we're going to need to get more guidance on what an FTE really means and how you calculate it. My simple example would be an FTE, a full-time equivalent, is a means to convert a part-time person to a full-time person. So in a simple math, assuming a 40-hour work week, if I had 2 people on my payroll that each worked 20 hours, that would be an equivalent of 1 FTE. If you have a worker who's a salaried person and they work 60 hours, that doesn't mean that they're 1.5. That's a full-time FTE, a full-time employee. So I don't think it's based on hours in aggregate. It's more of a concept of how do you convert part-time people to full-time equivalent status. I use 40 hours as my standard there, but I believe that the SBA is going to have to give us guidance. So for the sake of planning, again, because you don't want to necessarily wait forever to get started here, I would do it based on that and then know that you may need to adapt it based on their guidelines. So here's what they tell us to do to determine whether that amount of money that's eligible for forgiveness actually is forgiven. And this is the first test. So you have to, and I'm not going to read through all the verbiage here, but I'm going to give you the sense of what they want you to do. They're telling you to calculate the average number of FTEs during the covered period. So step 1 is you go to that 8-week period after you got the loan and you calculate the averages based on each payroll. You get an average FTE for that 2-month period of how many full-time equivalent employees you have during the 8 weeks. And then what you do is you compare it to a couple of choices. You can choose the period of February 15th of 19 through June of 19. Again, you got to get the average FTEs for each pay period there. Or you can choose the FTEs for the period beginning January 1st of 20 and February of 20. So we're going to stop there, and you're going to see this star that I have there. For those of you that are trying to game plan this a little bit, meaning get ahead of it and plan for it, this is here because you can go pull this information right now, and there's no reason to wait until later to calculate this. And so if you go back and you calculate your FTEs for this period of time last year, and you compare and you calculate them for this year, you want to pick the one that's the lowest, because that's going to be the lower threshold for you to comply with during the 8-week period. So you can go do this now, do the math on all these and figure out which one is most beneficial to you. And I have it starred because that's an action you can take today. So let's step back for a minute. And by the way, for seasonal employers out there, you can choose this other period last year. Most companies are going to pick one of these first 2. So let's just stand back and see what they're asking us to do. What they're saying is, we want to see if you retained your employees. So in my example, if we had that $900,000 that was available or eligible to be forgiven, I'll use an example. And let's just say we use a second bullet where we had 100 employees in January and February of this year. And then in that 8-week period after I got the loan, I had 90. So that ratio would be 90%. That means I retained 90% of my employees that were in it, on the payroll before all of this happened. And then in the subsequent 8-week period after I got the loan and I spent the money, I only retained 90% of them. In that case, I would lose 90%. I would keep 90% of my forgiveness, but I'd have to give up 10%. Or in this example, $90,000 would become part of my loan, and $810,000 would be forgiven, because the 90% the retention rate is how much of the loan that I actually can be forgiven at that point. The 10%, because I didn't retain 10% of my people on an FTE basis, I'd have to give back 10% of that in the form of a loan. I have to pay it back. So this is the first test. Next test is the maintenance of wages and salary levels. So what the SBA is saying here is that, and the language here is very specific, and I'm going to point it out, any reduction in total salary or wages of any employee. So the first thing to point out is it is not payroll costs with benefits and all that. It's just salaries or wages. So what they're saying is you've got to look at the individual payroll of each employee on your roster during this covered 8-week period. So you got to actually list it out what you're paying them. And that means their rates times their hours. It's gross pay during that period of time. And they want you to compare that to what you were paying them during the most recent full quarter. So that would be your 941 form for the quarter ended March 31st. So, excuse me. So you compare, you get their payroll by person during this 8-week period, and you compare it to their most recent full quarter. So I have this in red because the first thing is that if I think we can all figure out that if we were comparing 8 weeks of pay to 3 months of pay, we're going to fail that test. I don't think that that's the intent of the law, is to make you fail. And I'm sure we're going to get guidance on how to do it. But what I'm suggesting to people is that you're going to know what you paid people in this 2-month period. And when you go back and look at where they were in the most recent quarter, take those 3 months and convert them on a prorated basis to what it would look like on a 2-month payroll for an apples to apples comparison. That's what I'm suggesting to people. We got to get guidance on it, but they're not asking you to compare 8 weeks to 13 weeks. So the other thing that I'm going to mention is I have a star here. This is something you can go do now. Don't wait. You already have this data. Get your spreadsheet set up. Get all your employees' gross wages into that spreadsheet. And so you can do good comparisons today about where your wages are going to project at. So the way that this rule works is that what they're saying is you get the individual payroll of every employee on your roster during the 8-week period, and you compare it to a relative amount of pay that they got during the first quarter. And to the extent that their payroll is lower by more than 25%, that's a dollar for dollar reduction of your forgiveness amount. Now, it's not, if you go over 25%, it's not saying that all of it has to reduce your forgiveness, just the amount of a reduction greater than 25% for an individual employee. Now, lastly, and we're going to recap this in a minute, what they're also saying here is we want you to not worry about the highly compensated when you do this test. So anybody who had annualized salary in wages in greater than 100,000 for 2019, we do not have to count when we do this test. So what is the Department of, or the Small Business Administration saying here is, we are more worried about the wage and salary levels being decreased too much in the rank and file workers. We're not worried about the highly compensated. So when you do this test, you only have to calculate, this reduction in pay for the people who are earning less than 100,000 based on a prior year. So again, this is a dollar for dollar reduction. It's not a percentage test like the first one. It's a dollar for dollar reduction of the amount, to the extent that if a person, again, if somebody's wages went down by 20%, it's no adjustment. But if they went down by 26% compared to the first quarter, that 1% extra would be a reduction in the forgiveness amount. As if it's not complicated enough already, there is an exemption from both of these last two rules. And it's called an exemption for rehires. And this is an area you just want to make a note where they're going to need to give a lot of guidance about how exactly to do it. And it also is where I mentioned that June 30th date and why it's so important. So what this says is that the amount of your loan forgiveness shall be determined without regard to the reduction in FTEs and the reduction in salary. In other words, if you don't have to worry about, if you do these tests and you have a reduction in forgiveness, okay, you don't have to follow the answer there or the reduction if you do the following. And here's the ifs. There's two of them. One relates to each rule. If you had a reduction in your number of FTEs during February 15th through April 26th, so if you had to do a layoff already, and if by not later than June 30th, you eliminated the layoff, in other words, you restored the FTE levels by June 30th, you're exempt from having to follow whatever this rule told you have in the way of adjustment to your loan forgiveness. Now, the thing to remember is just because you bring everybody back, you still have to meet that test for what's eligible for forgiveness. So you can't look at this and say, gee, this is good because I'll just wait until June 15th to bring everybody back. You still have to spend the money in that period in order for it to be eligible to be forgiven. This is just a means to give people more time to recover if they've done layoffs. The second exemption relates to this rule. If you go through and you have a reduction in salaries and wages, you can be exempt from that if you had a reduction in the salary or wages of one or more employees during the same period up through April 26th, as compared to where you were on February 15th. So if you reduced wages during that period after April 15th through the 26th after February 15th through April 26th, if you did a reduction during that time, but if you restored the wage levels no later than June 30th to the same place that they were on February 15th, then you're exempt from that other calculation. So I'll make a comment here. So if anybody's interested, we wrote a blog last week. Sally and I were talking about it before we started the program. I don't believe that the law, when it was written, it was issued on the 27th of March. It was probably negotiated 2 to 3 weeks before that. I don't believe it was written with the expectation that the government was going to require complete closure of commerce. And I think a rule like this, while it's designed to help somebody who had to do a layoff, I don't think that they probably understood the order of magnitude of the effect of turning the business off for a period of time, and that it's going to be very hard for a business that had to completely close to rehire all their employees in such a short period of time. So I am hopeful that when they issue regulations, they're going to try to be sensitive if they can. I don't know how they do this within the government, but June 30th, if you think about it, if you got a loan today, your 8-week period is only going to give you 1 extra week until you get to June 30th for any extra time to bring your people back. So I'm hopeful that they may make these rules a little bit more liberal when they come out with the actual guidance, because things have changed. But our suggestion on these rules are that we would suggest that they extend the covered period longer for the companies that had to do layoffs. We would love it if they would push this June 30th date out further. And we also would, particularly for companies that were hurt the hardest, to eliminate this cap. That's our suggestion, but we don't know whether that's going to happen. And we certainly don't know whether anybody's listening to me. So, but that's just the way we see it, because we are working with a number of companies that were hurt very badly. So we'll see though, but pay close attention to what comes out. Certainly when guidance does comes out, we're going to be issuing details about that, and maybe we'll even get on another presentation here to go through those details. But for now, these are the rules the way they stand, and that's what you should plan for. Couple case studies. Assuming we get that $1 million PPP loan in our account, and then we go through the covered period and we have allowable costs, and again, this is a very high level example. Assuming we spend the money in the proper proportions, 75, 25, and so forth, we have allowable costs of $900. At that point, $100,000 becomes part of a 2-year loan, okay? Step 2. That means that if we spent $900 on allowable costs, we're eligible for $900 of forgiveness, not the whole $1 million. We had to spend it properly first. So that's what's eligible. So now we got to do the calculations to see whether there's any limitations on the amount of our loan forgiveness. So step 3 is we look at that employee retention calculation. That's that FTE during the 8-week period after the fact compared to the FTEs in a prior period. Again, you get to choose it. In an example here, I just said assume it's 90%. So in this case, 90% of the $900, $90 would become part of the loan. We already have 100 in the loan here. Now we've got another 90. That means that what's left over of the 900, 810 would go to the grant column, which is now going to be forgiven. The last step is you've got to look at those payroll levels before and after. Again, in that covered period compared to the prior quarter. And to the extent that the reductions are greater than 25% for any individual employee. I just made an assumption that that reduction is $50 in this example. So because of that, $50 would come out of the grant column and move over to the loan column, because that's a dollar for dollar adjustment. The 810 is a percentage ratio adjustment based on your FTEs, but the $50 is a dollar for dollar adjustment. So the conclusion of this case here is that on a $1 million loan, somebody would have gotten a $760 grant and a loan for $240. Next example. little bit different fact pattern. $1 million loan, allowable costs of 1.2 million. So in this case, the borrowers had plenty of costs to spend the money on. And the first thing to note is you cannot be forgiven. The forgivable amount is capped at the amount of the loan. You can't be forgiven more than you were actually given a loan for. So you spent more than the loan on those cost categories. The first outcome of that is you owe zero back at that point in terms of a loan, because the entire loan amount becomes eligible for forgiveness in step 2. So now we go to step 3. And this is an example of the way the program is intended to work. It's supposed to help people maintain employment levels and wage levels. So next step is you do the retention calculation of FTEs. Remember, average FTEs in the 8-week period after compared to a period prior. And let's just assume that that number is the same. In my earlier example, it was 100 before and it's 100 after the fact. So in that case, you would have 0 go to the loan column, and the entire amount of the $1 million would go into the forgiveness column and part of the grant. Then you do the last test, covered salaries. If you did not reduce anybody greater than 25%, that amount would be 0. So there'd be no adjustment to our grant amount or our forgiveness amount for that. So in this case, on the $1 million, this particular borrower would be forgiven the entire $1 million, and they'd have a 0 loan to pay back. Next one, same $1 million loan, covered period costs only $700. So at that point, you owe $300 back. $700 is the eligible amount of forgiveness. If you have a covered period, this retention rate of FTEs is just 70%. Again, I assumed 700 out of $1 million that you perhaps that relates to the number of employees that you were able to keep on board based on your business volume. So if you had 700 eligible to be forgiven and you only retain 70% of your employees, 30% of the 700 becomes part of the loan at this point. And 70% of the 700, or 490, becomes part of the forgiven amount or the grant. Assuming 0 adjustment for the salaries, you got no adjustment here, 0 here. So in this case, for somebody who could not spend all the money and not retain all their people, you could end up in a situation where you actually have a loan that's somewhat greater than the grant amount. And the last quick example is I just put in a rehire scenario just to demonstrate that. And this is a case, unfortunately, where I think a lot of companies are going to be that have had really drastic layoffs in a very short period of time. I've been working with companies that have, laid off all their workers in one morning when the governor shut the state down. So there are going to be companies in this scenario that are not going to be able to get forgiveness based on how the laws are currently written. So you have a loan of $1 million. You only can spend 400 because you haven't brought back most of your people. So you have a $600 loan at that point. 400 is the forgivable amount. And let's just say that I didn't put the math on those other tests, but you were able to rehire everybody by June 30th so that you didn't have any further reduction in your forgiveness. So you would get $400 to the grant column. And let's just say that you were able to restore the wages by June 30th. Because you went through a layoff, you would have no adjustment there. But the point is, you're still going to get hurt a lot if you're unable to bring back employees fast enough to spend the money in the proper categories. You still end up with a pretty big loan out of the gate, even though you rehired. So I'm hopeful to see, some improvement in what they issue in terms of regulations, and I'm sort of keeping my fingers crossed. Okay. So we're going to talk about the application process. So the first thing that's most important is that at the end of this 8-week period, after you measure and do all these calculations, nobody is allowed to receive forgiveness without submitting to the lender an application along with documentation. As I said earlier, the lender has 60 days to respond. Now, they do in the law list some examples of the documentation: payroll tax filings, state income and payroll and employment insurance filings, documentation including canceled checks, payments receipts, transcripts, other documents verifying mortgages, and so forth. So what's the point here? The point is that when you get to the end of this, you're not just going to fill out a piece of paper and send it to your lender. You're going to need to not only have your math put together, a spreadsheet, whatever you want to do, however you want to calculate everything to translate it to your loan forgiveness application, but you're going to need all the receipts. Those of you that have your books audited at the end of the year, or somebody does a reviewed financial statement, you've got to provide documentation as to your accounts. Well, that's what you need to be prepared to do here to meet the documentation requirements. So that's very important that you prepare. The point is that you don't want to, my suggestion here is you don't want to wait until the end to do all this, which leads us to the next slide. So what we're recommending to people is you should be doing this now. Like you should be, if you're in the covered period, or you're beginning to go into the covered period of where you got to measure everything, our advice is that it's best to track the usage of funds for allowable costs and collect the documentation as you go, because you need to have this at the end. First of all, you need the documentation anyway to be allowed to be forgiven. You can't just give them the math. Number two is, why not track it so you can keep track of where you stand rather than cross your fingers and hope it all works out at the end. So our suggestion is to track it along the way. Some suggestions that we're going to offer is, some people, not all, are using a separate bank account to track the usage of these funds. You are not required to do that. You are required to submit sufficient documentation that you've spent monies during this period of time on these purposes. You do not have to put it in a separate bank account. And so the point is that the money's fungible. It can be used. You just have to demonstrate that you've got documentation and receipts that you've spent the amount that you were given on the allowable costs. So you don't have to do this, but I do have some clients that are doing it this way just to be extra careful. By the way, I have some clients that are doing it this way because they may not be sure that they're going to need to use, they're not going to have enough cost to use all of the funds, and they don't want to have a loan at the end. So what they want to do is only take from this account as they need to spend it. And when they get to the end, if they don't need the money, they want to know exactly what to repay, and they kind of have the funds set aside. Another suggestion is use separate general ledger accounts to classify things separately during this time. Again, break things into all those categories of payroll costs, rent, utilities, internet, whatever those categories are. Break them out into a separate section of your general ledger. You can create sub-ledger accounts just to track things separately during this period of time so that you can keep your arms around it. Think about your payroll systems. When you get your you get your weekly or bi-weekly payroll reports, either do it immediately by hand, or ask your payroll provider to give you documentation for the FTEs for each, that's sort of right on the payroll reports. And certainly get all your documentation. As you spend money on these allowable costs, you've got to build a file with all your documentation, and it should be electronic, because I believe you're going to be, submitting this electronically. You're not going to be mailing in reams of paper, because it's going to go to your lender, and then your lender is going to take this documentation and have to submit it to the SBA for final approval. So I would be producing the documentation, every day that we spend something and we're tracking it, I would have like a separate file on my server somewhere where I get a PDF or whatever of the payroll report or whatever the electronic documentation is that supports all of your math as you go along. So I can't tell you how important I think this is. You should be doing this, if you're in the 8-week period now, you should be doing this every day as you spend the money. So that you're sort of tolling the amounts to make sure you're spending it properly, and you're accumulating all the documentation you're going to need to provide. Again, if you get to the end of this and you don't have the documentation, there's no forgiveness. So this next topic is something I've been working on with my clients for the last 3 weeks, because I started working with them as soon as this thing. We had our analysis of this law out. My clients got the first elements of it 4 in the morning on Friday, because we worked on it pretty much the whole day and that night to get it out in front of people. And we started having meetings with clients to help them understand the way the loan program was going to work, and also how to maximize their forgiveness. So what I want to say here is that it's so important, I believe, that all of us have some kind of an analysis going on about what's going on with our business today, right? What are our volumes going to look like? How's our cash flows going to change? Everybody's making difficult decisions about whether they need to do reductions or job sharing or furloughs or, any number of those things. And I've probably been on 100 calls in the last several weeks on this topic of planning and helping companies try to figure that out. And everybody is I would say, pretty actively engaged in that. What I'm telling you is I think it's so important to take these rules that have been presented here. And look, even though we know that they're probably going to change a little bit, these at least give you a sense of direction about the way this stuff's going to be calculated. Again, you can always adjust later when you get the regulations, but for now, if all you did was get the information that's in the law, the way it's been split up here into some level of detail, and include that into your planning analysis. If you're doing scenario planning, if you're doing analysis on how many people to retain and all that other stuff, you should, I suggest strongly that you should be projecting your allowable costs in all the categories by looking out at what it's going to look like in that 8-week period. How many payrolls do we have in that period? How much do we have in rent in that period? Do that projection now. Number two, you can project, you have the ability to go back, as I said earlier, and pull out which is the most favorable period of comparison of that FTE test. You also can project what your FTEs look like, so that as you make decisions about what to do with the business, depending on whether you got to make more changes or bring people back, I'd encourage you to make sure that you include all of these formulas and rules for the forgiveness in your planning so that you can determine the result of your decisions and whether it has an effect on your loan forgiveness. And then lastly, wage and salary levels. Again, go back, you can go back and get what those levels are for the first quarter. And then when you do your forecasting for your business about how it's going to look going forward, and you project wage and salary levels, you can then sort of have a separate calculation running about how your decisions will affect your forgiveness calculations. I don't want to confuse the fact that I'm telling people you should do what you need to do to keep the business operating. That's the first and foremost thing. However, if you can know small details about how to maximize your forgiveness while you're making those decisions, it's going to be very valuable later if you're able to not have a loan to repay. So make sure you try to take these rules and integrate it into your planning. So a few more planning considerations before we wrap up, and a few things that I just want to mention. Back to this whole definition of, language in the act is costs incurred and payments made during the cover period. Again, my simple explanation of that, at least the way I see it, is do it the same way that you would have done it on the way in terms of paying for things. I don't believe they're looking at whether they'll find reasons to exclude things. But I expect we're going to get some guidance there. But some planning considerations, obviously, thinking about your FTE calculations, the timing of those, the handling of part-time and job sharing situations, short shift workers. I have clients that have done, versions of all of these things, some that have gone to a shorter week with 2 different shifts. I've got one client that's going to 3 shifts with fewer people to keep people separated from each other. Another important thing to note, those of you that are participating in the payroll tax deferral program, and for those of you, if you don't know what that is, it's part of the act where you have the ability to defer paying the employer's share of your FICA tax. So with an election, you can not pay your FICA tax for a period of time, and that is not payable until half of it at the end of 2021 and the other half at the end of 2022. So it's designed to be a tax-free loan for a company. So you can, the employer's match, not the employee share, but the employer's match of FICA is only, you can decide not to pay it today and defer it for either 1 or 2 years. So it's designed to be an interest-free loan. There's a lot of clients that we're working with that are taking advantage of that, especially the ones that are the hardest hit. An important note here is that your forgiveness, you can continue to participate in that program up to the point that your loan is forgiven, not up to the point that you receive the loan. It's a huge distinction. And our tax group did a great job a few weeks ago of reading through that into the regulations. So if you're on that program, you can continue to defer those FICA tax payments up to the point that you receive forgiveness on your loan. So in that respect, you may want to delay it a little bit to extend the time if you're taking advantage of that program, you may want to delay the application for forgiveness a little bit to try to maximize the amount that you can borrow under this FICA tax program. Timing of layoffs, reductions, we talked about. I want to talk about a few other things, though, that are coming up in a lot of questions, and I don't have answers, but I'm going to try to give you my sense of direction here. So rent payments, leases, and related parties. There was nothing in the act that talked about related party leases. We've gotten a lot of questions about, gee, if I need more costs in this covered period, I'm just going to increase my rent. I'm going to pay the rest of my year's rent payments. I would be careful about doing that. I believe that there's going to be part of the regulations, there's going to be limitations on that so that there's not abuse of those rules. So for now, I would, as you project out what you're going to do, you might want to keep that idea in your hip pocket, but I'm not sure I would count on it at this point until regulations are issued. Again, there's no restrictions in the law about leases paid to a related company because many of us lease the building that the business is in to another entity. But I believe what I would hang my hat on is what the lease says that was in existence prior to February 15th. I think that's going to be a pretty important determinant about the amount of rent. The second question, another question we've gotten is, I have some Q1 incentives, commissions and bonuses because of, sales incentives and so forth. What about, why don't I just wait and pay those? It's a great question. I don't know whether there's going to be any restrictions on the ability to do that. But what I'm suggesting to people is that if you're, you have those things are typically paid for in April. And if you still have those, then they're unpaid. It can't hurt to wait a little bit more, a little bit longer and pay them in the covered period. The worst thing that can happen is that they may be excluded because, they're a special sort of situation. But right now, there's nothing in the law that says that they're not able to be counted as allowable costs. So when people have asked me about this, my response is I would probably wait until the covered period to pay them, but know that you may not be able to count on them as covered period costs because they may get excluded later. But it doesn't hurt if it's a matter of waiting an extra week or so to pay some of these things. It probably is not a bad idea. And then just know that you may need to adjust later. And then the other one we've gotten a lot of questions about is my profit sharing payments. We have a lot of companies who have their 2019 profit sharing contribution that they defer paying until they file their federal income tax return. And can we pay that? And that, by the way, that includes ESOP companies because we do a lot of those. They haven't made their contribution to their ESOP for the current year. So can we do that? There's nothing in the law that says that you can't. I would just pay attention to whether there's anything unique about, making large special payments besides your normal match on 401k and so forth that goes with your payroll. So I wanted to just, highlight some of these unique things. And what I'm suggesting to people is that as you project out, make note of things like, whether you can pay more rent, whether equipment leases might be included, whether you can still pay your profit sharing. I would keep track of all those ideas and all those thoughts, but I wouldn't count on them. I would look at my normal run rate of payroll, rent, all the typical ways that you would run your business and count the things that fall within the spirit of the law. And if the regulations come out and allow some of these things or don't allow them, or maybe they stay silent on them, then you can decide then whether you want to count, and do some of these other things like pay your profit sharing calculation or your profit sharing for 2019 during the period. But I wouldn't count on it is all I'm saying. I would plan based on your normal operations of your business, and I would plan based on the basis at which you made the loan application. And if these other things come into play and they can work, then we would want to make them work. You also got to remember that this has to meet with the approval of your lender because they're going to be, lender's not going to call me and ask me what I think. They're going to have their own rules about how they're going to do this. And so you want to be communicating with them way in advance, sharing your ideas. Certainly, if there's anything I can do for anybody, we're working with dozens of companies to help them plan these calculations, helping them with their modeling of their business. And certainly, if there's things we can do to help, we'd be glad to. So a few more slides, and then we're going to wrap up, Sally. So what happens if you don't qualify for loan forgiveness? First thing is, as I said earlier, we do have some clients who don't feel like they want to have a loan on the other side of this. So they're kind of keeping track of everything separately. If you get through the 8-week period and you do the math on the amounts eligible for forgiveness, and in my example earlier, you got $1 million loan and you only spent 900 of it, you can take that 100 and pay it back right away. There's no prepayment penalty in this loan. So companies that have enough capital in their business that they can afford to do that, there are people that don't want any more debt as a result of this. And I have several of those that are going to be able to use this to some degree, but not fully, and they expect to repay the amount that they're not going to use. On the other hand, if you're a company that, and again, I'm so hopeful that they relax some of these requirements for the hardest hit companies, because I'm working with a bunch of them. Again, several who've had to lay everyone off in one morning. It was a heartbreaking discussion with them that day. But there are companies that are in that most difficult of a shape. And what those companies may end up with, if these rules don't change, is you may end up at the end of this with a loan. Now, the loan is a pretty favorable loan. It's a 2-year maturity. By the way, I'm hopeful that they might extend this back. Originally, this was a 10-year loan in the act, and they changed it to 2 years. So that's another change that I'm hoping that they may relax, is to make this loan longer so that it doesn't amortize over a short period. But these are pretty favorable loans, no personal guarantees, no collateral. So if you're a company who goes through this and you've had to lay people off, and I have a client who received their loan proceeds last week, but they still can't open their doors because the governor, they're a non-essential business, they can't go back to work. So they're already in the covered period and they can't bring back any employees because they have no revenues. They're not going to meet the test for forgiveness. In that case, there's a decision to be made. If the business is harmed to that degree so severely because their revenues are just turned off, the worst case scenario is you do have at least the ability to have access to credit that you otherwise would not have had, in a difficult time. It'd be hard to get a loan in that environment, but at least they've been able to get access to capital that now they can use to keep their business afloat, to at least reemerge once the economy reopens. So it's not the best scenario, but I would also say it's not the worst, in that at least you've been given access to capital. And again, I'm so hopeful that this 2 years gets extended back. It was 10 in the law, and they changed it to 2 in the first set of regulations they issued. Just a quick comment on taxes, and then we're finished. The debt forgiveness within the law says that the debt forgiveness amount shall be excluded from gross income, which means it's not included in your taxable income. However, there's a potential conflict with other sections of the IRS code where costs related to activities that are related to tax-exempt income, those costs are not always deductible. So there's a conflict in the code here between what this law says and what the existing IRS regulations say. So there's some confusion today over whether, even though this amount is excluded from income, whether the costs in that period are going to be deductible expenses. So there's going to be guidance issued here, and I would just make sure that you pay attention to it, and certainly ask your advisor, ask me. Our tax group has been very heavily focused on this, and we're kind of waiting for this. But this needs to be clarified. I think the intent, though, is that it's not going to be taxable. The other thing to make note of is the taxability at the state level is unclear. So just because it got forgiven for federal taxes doesn't mean the state is going to be forgivable. Those are all my slides. Certainly, if there's anything I can do, my email is on the first slide. If anyone has questions, or if there's anything we can do to help anybody, we'd be glad to do it. So Sally, back to you.
Well, thank you so much, Mario. And yes, there's quite a few questions. And as Mario said, feel free to get to him directly, email him directly. Just a word that we have 2 more webinars that are on the calendar for May. We'll probably be putting others in as well. May 1, we're going to be doing one on roles, boundaries, and the resilience in our families that Jared and I will be presenting on. And then Thursday, May 14, Greg McCann will be presenting on leadership agility. This will be the second time he'll be presenting to our group. Should be really dynamite. So thank you all for joining us. And a reminder, you can access the recording, the video, and the slides from our website, and you can email Mario for questions. Thank you, everybody.
Thanks, everybody. Stay safe.